Hello everyone, it's Professor Reiko. Today we're going to walk through our last video in the Cash and Receivables chapter. And this is on our second video on the notes not issued at face value, but this time we're going to look at ones that are interest bearing as opposed to our last one where they were zero interest or non-interest bearing. All right, the rest of your book, has some other things in this chapter like selling receivables, secured borrowing, things like that. So some of the items I don't usually get into in my class in that great of detail, so I didn't do a video on them. But obviously, if your teacher or whoever you have as a professor for your class gets into other items, make sure obviously you have to pay attention to that and be prepared to answer questions on those come exam time. All right, so interest bearing, the main difference here is that there is a stated rate explicit on the note. Okay, whereas the non-interest bearing ones there were not. All right, so the stated rate differs from the effective rate. Effective rate, market rate are the same thing. All right. So the initial journal entry to record the note receivable is the same as the zero interest bearing note, with the exception that there could be a premium on the note. If so, you would just debit the premium and then a discount would be a credit. All right. So if we had the discount like we did on the previous page or the previous video, I'm sorry, we would have a credit. All right. So a couple things to keep in mind is the note receivable, once again, is the face value of the note. Okay, and the cash is going to be the present value of the note. All right. So once again, this is the face, and this is the present value, and we'll do an example where we calculate the present value on the at the bottom of the page here. So that is exactly what we did on the zero interest bearing notes in the previous video. Okay, so make sure you note the similarities because sometimes that's where students get confused. There's a lot of similarities, and so they end up doing the wrong problem. They'll end up doing an interest bearing note journal entries when it's a non-interest bearing note, because as we move forward, we'll see that things change just a little bit. All right, so since there's a stated rate of interest on the note, the interest is received in cash each period. So notice here, we're going to have a debit to cash each period. This amount can be determined by multiplying the face value of the note by the stated rate of the note. Okay, so face value of the note times the stated rate that is on the note. All right, the entry to recognize interest revenue in the receipt of interest is as follows, and the effective interest method is still used, which means this is the carrying value of the note times the market rate. All right, so the carrying value of the note at the beginning of the period times the market rate. All right, so notice this is the same as the zero, that's kind of sloppy, zero interest bearing note. All right, so it's the exact same calculation. So we'll set the effective interest table when we do the example. The only difference is we're now receiving cash. So in the previous example, we had discount, so it had been a debit to a discount. The discount was equal to the interest revenue because there was no cash. Now there is cash, so it changed things up a little bit. All right, so once again, the stated rate is used to get the cash number. All right, so notice this, stated rate's used here, market rate's used there. All right, so let's do an example on January 5th. So if you haven't watched the previous video, go back and watch that on the zero interest bearing note. What we're doing here is I'm using the exact same example. The only difference is I'm adding in this 10% stated interest rate. All right. So the 2-year note, 200,000 face value, 12% market rate is all the same. Okay, but now there's going to be interest that's paid each December 31st, and that that cash will be based on that 10% stated rate. All right, so let's walk through this example. And the first thing we need to do is calculate the present value. So once again, I use I use my financial calculator to do this. All right, so future value, payment, number of periods, and the interest rate, and then we're going to compute the present value. All right, so the future value is the face amount of the note. So at the end of the note, they're going to pay us back $200,000. The payment, all right, in this case is the interest, all right? So we can calculate that, all right? So the interest received, I should have done that up there. Let's just do it down here. So the interest received that we're going to receive each year is, remember, we set up there, it's the face value. If you look up here, we're basically doing this calculation right here. All right, so we have the 200,000 times the stated rate, which was 10%. All right, and technically, interest is principal times rate times time, but since it's an entire year, all right, we're basically multiplying it times 12/12, which is 1. All right, so all 12 months, the interest rates are based on a year, but we're using all 12 months because we're only doing this. The interest is payable once a year, okay, at the end of the year, so all 12 months are included. All right, so that works out to be 20,000. All right, so that's what we're going to receive in interest. All right, so remember, when you're doing your present value calculations and you're using a financial calculator, the payment represents the annuity. All right, so this is an ordinary annuity because the interest is going to be paid at the end of the year. So if you're using your present value tables, this is going to be the present value of an ordinary annuity. So you'll have to get that factor, and this will be the present value. Usually they say present value of $1 or sometimes present value of a lump sum. So you're going to have to calculate the present value of both of those numbers and then add them together. And if you're using your table, you're going to go to the intersection of two periods at 12%. All right, so you can see by using my calculator, I just punch those numbers in and then hit compute present value, and it gives me my answer real quick. Right, so I'm a big proponent of getting a financial calculator, learning how to do the present value function. It will save you time and probably reduce the amount of mistakes you'll make. Because if you look here, I have to go to two different present value tables, pull off a factor for each one of them, multiply it, and then add the two numbers that I get together to get the 193. You'll get the right answer, but it just takes a little bit more time. There's a little bit more margin for error. All right, so we're going to do the journal entry at the top, except we have a discount. All right, so notice the accounts here look just like the journal entry we did, the first journal entry in it's exactly the same. Okay, the note receivable is still 200,000, it's still the face amount. The cash number has changed. All right, so it's now 193,240, which makes my discount 6760. All right, so same journal entry, just a few different numbers here. All right, so let's go over here and do our effective interest table. All right, so once again, the carrying value of the note, I wrote this on the previous video, is the note receivable less the discount. All right, so the carrying value is 200,000 less that 6,700 discount. So this is 193,240. All right, so the interest received we know is 20,000 because that's based on the stated rate of the note, and so we're going to receive 20,000 each period. All right, interest revenue, remember, is the beginning of the period carrying value times the market rate, which is 12%. All right, so that gives me 23,189. All right, and then this becomes 31,89. All right, so my discount, so just like I did on the previous one, my discount T account right here, 6760 from the first entry, and then I just amortize 3189. So that it leaves me with 3571 account. All right. So remember, the carrying value definition is the note receivable. So we're now saying 200,000 less this 3571, and that gives me 196,429. All right, now take the 196,429 times the 12% to get 23,571, and this is 3571. So notice if I have amortized 3571 more, my ending balance is 0, but that's what I want, which means this is now 200,000. All right. So my journal entries. All right. So 12/31/15, we have to record our interest revenue. All right. So the difference between this one and the non-interest bearing note is we're now receiving interest. So we're receiving the cash payment for interest. So we have the cash. We reduce the discount on note receivable by the 3189, and this is interest revenue of 23,189. So I'm just pulling the numbers from the table. Notice that 3189 is right there. On 12/31/16, we do our second year interest. So we have cash 20,000. We reduce the discount on note receivable by the 3571. And we record the interest revenue for 23,571. So once again, that is that. $35.71 right there. But then also on the last day, we need to receive our payment for the note. They're paying us back to $200,000, and we close out the note receivable $200,000. All right. So once again, this is now zero. All right. My discount account is now zero. So everything with the note has been closed out. We're done with this note and we're good to go. All right. So once again, I keep stressing this, but come test time, make sure if you have a note receivable problem on the test, which, let's face it, if you look at the problems we did, that's, it's a pretty good likelihood that you might. I mean, it's kind of a longer, a little bit more involved problem for this chapter. So make sure that you are really pay attention. Is there, they're going to give you a market rate, okay? But then what is the stated rate? If the stated rate is not given, it's a non-interest bearing note, which was the last video I did. If there is a stated rate, then it's this video. So you really need to make sure you pay attention. There are some similarities. The big difference here is in our journal entries here, we have our debits to cash because we're actually receiving an interest payment. All right, so make sure you're clear on that. Come back and review these before your test. Hopefully they give you provide you with another example that's different than what you've done in your class and in homework, and hopefully it'll help you prepare better for the exam. All right, so I hope you're enjoying this. This concludes this cash and receivables chapter. Please subscribe to my channel. It does help me out, and please share with your friends. Hopefully it will help them as well. All right, I'll see you when we start the next chapter. Thanks.